It's having that ownership knowledge and being able to be a lender with, because we're not lending with the idea of owning these assets. We never want to own any asset we make a loan to, but it's understanding what it means to be the owner. It gives us an appreciation.
Hey everyone, thanks for jumping in. Put your bags down, relax, and welcome to the Room Key, where we navigate dislocated markets without losing our luggage. Today I'm joined by Greg Friedman, founder and CEO of Peachtree Group, a vertically integrated platform spanning hotel acquisitions, development, credit, and management. His career is about turning dislocated markets into risk and opportunity. Today we're going to unpack his founder journey, Peachtree's operating system, and the structures they use to win when the markets get weird. Greg, going way back, where are you from? Where did you grow up?
Yeah. So originally, and by the way, thanks for having me on your podcast. So I look forward to spending a little bit of time with you today. But basically, I grew up in a small town in Alabama. Moved to Texas when I was 10 years old. Went to college at University of Texas at Austin. I graduated from Texas. I went into banking where I specialized into financing primarily hotel projects. Where I financed branded hotel projects across the U.S. Did some non-branded hotels and had financed hundreds and hundreds of different hotel projects, either through doing like senior debt financing. I did a bunch of FF&E loans on hotels as well early into my career, but then eventually did a bunch of construction loans, acquisition loans on hotel properties. And that's how I first got in, from a professional perspective, got into business. Although personally, I did grow up in a family that had owned some hotels, so I had some personal experience around it. It was cheap labor, many summers working my grandfather, helping my mom, who worked for my grandfather as well, and was part of she was part of the actual family business. I never worked in the family business, or at least never worked on the payroll. Never worked officially on the payroll, but had the benefit of spending many summers, helping them out, as well as my grandfather actually financed, surprisingly, had a business that did a lot of financing of hotels. So personally grew up around it. Professionally have been around the hotel space and been around the credit space as well my whole career. And so it's a little bit unique. And then obviously started Peachtree after my banking career back in 2007. Started Peachtree, and we've had a really good run over the last 18 years.
Yeah, absolutely. So you've been in and around the hotel industry for forever, your whole life. Is there
That's right.
anybody in particular that helped shaped your approach to risk and relationships the most?
Yeah, I would say it was my grandfather. So my grandfather was a huge influence on my life. He was a POW, a prisoner of war
Really?
from World War II. So he had a very unique personality in a good way. When I say unique personality, he was very disciplined in how he approached everything in life, the way his personal life, his professional life. He was, very big, staying the course. He was big on temperament. He was, although he was very entrepreneurial, he was a doctor by trade after World War II. He became an optometrist. When I say a doctor by trade, he got into, owning real estate, like owned a home building business, on movie theaters. As I mentioned, got into the credit space or finance space where he started financing hotels and medical practices. So he was a true entrepreneur, but he had a lot of grit about him, and say a lot of his characteristics sort of eventually found its way to me. But he really shaped my mentality of how I think how I work, how I worked not only or how I live my life on a personal side, but how I work in a professional setting, keeping that discipline. And as your question was really related to risk, it's that discipline, making investments, and being able to check your downside, let your upside work itself out. Having that mentality kind of mitigate your risk, because when you make investments, especially us as a firm, we've made close to 800 investments, which is pretty crazy to think. We've made 800 investments over the last 18 years, made close to 800 investments. That's us buying assets, developing assets. When I say buying, develop hotel assets, a lot of branded hotels. We've also done stuff outside the hotel space, across like the residential space where we buy larger tracts of land, we entitle into subdivisions, sell the lots off to major public home builders. We've done stuff in iOS. We've also, and that's all on the equity side. On the credit side, we've done everything from buying loans from banks to making direct loans across the commercial real estate ecosystem. A lot of that is hotel related. Finance a lot of hotel projects, provide a lot of construction loans, bought a bunch of loans from banks, as I mentioned. And so we've done a lot of business through the 18 years. And the best way we've been able to, manage risk is staying disciplined to our strategy, and staying disciplined to when we underwrite investments, the fundamentals that make good real estate investment. It's on the credit side or the equity.
Yeah, that's such an incredible history there. Did you know, obviously, you had so much history in hotels. Did you start Peachtree knowing that you were going to be heavy in the hospitality space?
Yeah. So when I originally started the business, it was myself, my partner, Matul Patel. So the two of us started the business together. When we started it, we did expect to be just hotel properties. We were anticipating just going out. We actually did this probably at the worst time. We did it back in May of 2007 before the great financial crisis. We set out,
Yes.
effectively, we made about 8 investments in different hotel assets where we bought them. And then we set up a bunch of development deals. We were going to build some hotels from the ground up. And it was going to be Peachtree was going to be just an investment vehicle for hotel assets that were limited and select service hotels. And like all great plans, had to quickly pivot as soon as the great financial crisis occurred. And that's really what changed the course of what Peachtree ultimately became, because of 2009, because we had to pivot. We had to quickly play defense across the investments that we had, which we were very successful playing defense across those investments. That's why we internalized, because up until really 2008, 2009, we didn't operate hotels, but we had to internalize the operation because we wanted to be able to be defensive across our investments. We weren't really happy with our third party operators. We, internalized the development side because we had some land sites that we were developing, and then we put ourselves in a position to go play offense. And playing offense back during, right there, the beginning of the great financial crisis, it was actually buying debt. You couldn't find anything to buy on the equity side. You had to buy everything through debt that was trading at a huge discount. We were able to step in and we bought a bunch of loans, and we actually brought in, for the GFC, we brought in a third partner who's now our CFO, and myself, partner who's Jutton Desai. Jutton and I, I'm the CEO of Peachtree. He's the CFO, and two of us really run the business daily. But we went out back in 2009, 2010, 11, with Jutton joining. The two of us went out aggressively, bought up debt positions. And that's when we pivoted from being hotel only to being really diversified, not only between property types and so forth, being diversified, investing credit as well as equity as it relates to hotels and commercial real estate. Really transitioned the business from just being an investment vehicle to being a private equity firm that really finds mispriced risk in the marketplace and takes advantage of that mispriced risk to the benefit of our stakeholders.
Yeah, that's an incredible story. And again, some similarities there again from what you learned from your grandfather and what he went through, and you immediately jumping into Peachtree and going through the GFC. I would imagine there's a lot of crossover on what you learned, what you went through, as far as having to really be disciplined, look for the best, and just work through the hard times in order to come out on top. And clearly, you have.
Yeah, no, it's interesting. Like your point, having my grandfather as someone that was a huge influence on my life, having really changing the direction of my life. I mean, the characteristics that he really, built up into me was that temperament, not getting so, never letting emotions, dictate decisions, because that's where people make mistakes. And we saw that during the great financial crisis. I saw that during the pandemic. You even see it to a certain degree today, because the market is still very heavily dislocated with, I'm sure you're seeing it on your side as well, Chase, just with all the loans that are maturing and so forth. That's creating a lot of challenges for owners, and it's staying the course. It's being disciplined. It's constantly, just managing everything, hour by hour, day by day, not getting so caught up in the drama. Because I saw a lot of people that unfortunately lost a bunch of money during the great financial crisis and even during the pandemic, where they made very rapid decisions unnecessarily, and they should have been a little bit more thoughtful. Their temperament should have been what they leaned on, to make it through, and they sort of lost that. And I think, the one thing I didn't say that he really instilled was being very, making sure you always communicate, be very transparent, do what's right, even when people, do what's right. It's easy for people to say do what's right? Like everyone says, yeah, I'm going to do what's right, but when no one's looking, can you do what's right? And as crazy as it sounds, there's a lot of people in this world that struggle doing what's truly right when no one's looking. And he was big on that as well. And that's, something I even live by today is, I mean, we've worked with all our lenders during using the great financial crisis. None of them took losses. Same thing occurred during the pandemic. We worked with our lenders and we didn't, force anyone ever to take an unnecessary loss. And, I've seen a lot of games that have been played by other groups over time. And maybe it's, maybe you could argue, some people would say, oh, maybe that's foolish on your side, but I do think it's about doing what's right and making sure when you, commit to something, you see it through to the finish line.
Yeah, absolutely. There's a lot in there, and even the whole concept, right, with working with banks, and you're working on a much different level than most investors are. Banks love to lend to you when you don't need it, but they're very difficult to work with when you really need the loan, you need to refinance, you need the money. It's very difficult, and the ones that do work with you, that take a risk with you, you want to stick with them forever. They took a risk on you. Sticking with them going forward, doing the right thing again just builds that relationship long term. And it sounds like that's exactly what you've done your whole career.
That's right. Because and it's no different. Like we act as a lender, we obviously borrow money too. And so it's always interesting when we have discussions with borrowers that are struggling because sometimes they lose sight of the fact that we aren't equity in these assets. We don't get the upside, we don't get the benefit of
Yeah.
if someone makes 20 investments and 10 of them turn out to be absolute home runs where they, 3x their equity investment or whatever the case is, we don't get any benefits on any. I mean, we only get the stated coupon. So if the stated rate's 8%, we only make 8%. And if it's over 5 years, we're only making, assuming, we're only making a 140 multiple, on our investment using, an equity multiple. Whereas if they made a 3x, great for them on those 10 deals. But if all of a sudden they have a couple of deals that aren't working out for them, a lot of times borrowers will come and be like, hey, I think you should share in this. And it's like, no, well, we didn't share in the other deals, right? That all went right because
Yes.
you're effectively getting the benefit. You're getting the arbitrage off this capital. And that's where I think, fortunately, I think that's the challenge in our world today is a lot of people like to take. They don't like to give back. And I'm a big believer in this world. It's about giving and taking. And that's, as it relates to the hotel space, because I mean, this is more hotel centric discussion today. uh, you know, I think sometimes people lose sight of the fact that because there's challenges that we have with brands from time to time. There's challenges you have with lenders, with management companies, but it's all one ecosystem where everyone's got to sort of work together because there is give and take, and everyone sort of should understand what's truly behind each entity. Like the brands today, they're not owners of assets. They're not operate. I mean, well, I guess some of them are still operators of assets, but they don't own assets. They're not there to backstop your performance. I mean, they're really there just to lend the brand, and they've made that very clear to Wall Street, right? Like, so you got to understand that there's a misalignment of interest there. Same with management companies. They're there to operate your hotel. They're not there to be an owner of your asset. That in both cases, the brands and the operators want to see that you're successful, but understanding how all that correlates and not necessarily expecting them to be the solution to your issues is one thing that I think sometimes we all lose sight of. And we there's expectations that are again set, and people sometimes leave sorely disappointed. And that's what happens on the lending side is sometimes people expect us to take discounts or whatever the case is when it's really not warranted given what I said before.
Exactly. It's not your fault. It's not your risk on that side. Obviously, the GFC was not your fault, not your mistake. But are there any painful early mistakes that you did make that you wouldn't trade away today because it's hardened your operating system, your how you work, the decisions you make?
Yeah, I mean, we've made thousands of mistakes. I mean, it's like that Michael Jordan comment about missing 10,000 shots or 10,000 winning shots, and
Yes.
because of it, he won so many championships. So or I forget how the quote goes, but that's the same thing. We make mistakes on a daily basis. And it's, the one thing is mistakes are never fatal. Like it's like that. I think it was Churchill that, basically said failure is never fatal. I mean, failure is truly never fatal. And success is never constant either, right? Like, so you can't expect
Yes.
success is always going to sustain and exist. It's just the ability to continue to move forward, learn from the mistakes, and hopefully not repeat the mistakes. Sometimes people struggle with that. That's one thing we you know, try to spend time on when we do make mistakes, trying to make sure we don't reenact it. But we've made mistakes on the investment side. We've made mistakes on how we manage the team at times. We've made mistakes on strategies and everything else. But it's, probably some of the mistakes that we made that I look back on and, I leave somewhat disappointed is because I feel like most of the mistakes we've redeemed ourselves over time. I feel like we made a huge mistake during, like, for instance, in the great financial crisis. We should have bought so much more when we had the opportunity to. Back in 2010, 2011, we bought about 50 first mortgage loans, secured by different commercial real estate assets. A lot of that was hotel assets. We probably could have bought hundreds of loans, and we should have bought hundreds of loans. So me being the opportunistic individual that loves to find ways to you know create financial rewards for our business and for our team members. I think we missed on a huge opportunity there. I think we've missed on COVID. It was another just total mistake. Like on the investment side, I think we did it totally right. We bought as many loans as we could. We bought over 180 loans during COVID, so we were super successful during COVID, being able to invest. The biggest mistake I think we made during COVID is sort of missing how fast the market was going to recover. Although we didn't furlough, we basically kept 98% of our team, back at the beginning of COVID. We made the decision, we backed up the truck internally and backstopped the business. Myself, my partner Jutton and Matul, we all backstopped the business and said, okay, we're going to have enough capital to ride this out for the next several years. So we kept the whole entire corporate team, or at least 98% of the corporate team. But then what we did is we furloughed off all the team down below at the assets because we had no visibility of the recovery of lodging. Obviously, it was a lot quicker. In hindsight, we should have kept more of the team in place at the property levels because the recovery came back a lot quicker. It's but it's probably, I mean, I guess as you look at it all, and I can give a lot of different examples. I think the biggest thing, just as I reflect on the question and reflect on the discussion we just had, is thinking about just the biggest, I would say, we've had a lot of little failures, but the biggest lesson from it all goes back to just, staying the course, building a business that is sustainable through these, components. And so making sure you're putting the right team members in the right place and making sure you have the right capitalization as it relates to having enough capital to ride through these cycles where you don't have too much leverage underneath at the assets, at the individual assets, and then corporately having enough liquidity to be able to ride through these black swan events or economic down cycles and so forth.
Yeah. You're obviously at the helm. You're in charge of the rudder of the Peachtree ship. How do you make the decisions as far as we have a business plan, we have a whatever a 5 year, 10 year plan, we're going to stick to this versus here's what's happening in the market, COVID comes up, whatever big shift happens, how do you make that decision? Do we follow this path that is now changed, or do we stick true to what we had planned on regardless of what happens around us?
Yeah. So we try to build businesses that we think can stand the test of time, right? Like, so for instance, we have a lending business, our credit business, a lot of people call it private credit. new word that everybody started using about 2, 3 years ago, media. But the reality is, we've had our credit business for the last 15 years. And I'm just using this as an example. That is a business we expect to exist for the next 20, 30 years, no matter what's happening. But the actual way we're executing in that business may change over time. So we pivot our strategy within that business based on where the inefficiency exists. So if insurance companies and banks are super active and they're going to be doing higher leverage loans on stabilized assets, we're not going to be financing stabilized assets, and that's historically been the case over the last 15 years. There's been moments of time like during COVID or during the last couple of years where you've seen some of these lenders pull back, but in general, where the inefficiency exists is us doing transitional loans. And so, but then all of a sudden you'll have an event pandemic, right? Where all of a sudden we can pivot and no longer, we continue to try to make loans, but it was much more beneficial for us to go out and buy. And so we saw a bigger opportunity set. So that we pivoted our investment strategy within that business to focus on buying loans. So ultimately, to sort of simplify to your question, it's all about that power of being able to pivot and basically say, okay, I can sit here and try to go, buy stabilized hotels, but it doesn't make sense. I need to go buy value add hotels because that's where there's more opportunity, or maybe that there's no opportunity in buying hotels. There's no opportunities in buying stabilized or value add hotels. Better to be developing hotels, and we have a development company. Or it's better, maybe it doesn't make sense to invest on the equity side at any scalable level. Maybe you could find some one-off investments, but it's better to be on the credit side. And so we will pivot our strategies accordingly based on where we see market conditions and where we find that we can, basically put our capital in a position to get the best risk adjusted returns. And us having that ability to invest up and down the capital stack is a huge competitive advantage to other groups because our survival is not dictated by just one strategy or just, when I say one strategy, us just developing hotels or buying hotels or even lending to hotels. We can pivot, and there's always something that's going to make sense, because if lending doesn't make sense, that means the market must be super hot. There must be a lot of liquidity in the market. Probably makes sense of buying some assets, at that.
Yeah, absolutely. You rebranded from Peachtree Hotel Group to Peachtree Group. Did you see any negative interactions, either on the side where now you're known as the hotel guy and going after the non-hotel opportunities, or from the hotel side, them saying like, well, you're no longer just hotels, you're too spread out?
Yeah, so we did deal with some challenges there. Where it was probably more in the latter, where people are like, "Oh, you're doing this non-hotel stuff. Are you too spread out?" Or whatever the case is. To your point, but most people didn't realize we were already doing that going back to 2010. So it was an education process where I was like, "Hey, look, did you know we bought a bunch of busted subdivisions back in 2010?" And well, people would be like, "Oh, well, so and so, says you're, like." Literally had this conversation with somebody. They're like, "Oh, well, you compete against these, this group, this other group that's, bills themselves as a private equity to hotels only." And I'm like, "Well, no, we don't. We do, but we don't. We don't view ourselves as competition to them because we do other stuff. We're in the business of finding mispriced risk, and the mispriced risk could exist in hotels. It could exist in multifamily. It could exist in buying cell phone towers, right? Like, or making loans to cell phone towers. It could exist anywhere, wherever we can find mispriced risk, where we can get outsized returns relative to the risk. That's where we're going to focus our time and energy. It just happens to be the reason hotels is such a big part of our ecosystem is the fact that hotels tend to be the most dislocated property type across commercial real estate, because it's a daily business. It's real estate and it's operations, and you don't you feel the pain of every economic cycle and the down cycle, and you feel the benefit as it recovers as well too. So it can be an incredible business. It can be a very challenging business within 24 hours, as we've learned through the pandemic, where everything's going well, and all of a sudden it falls off the cliff. So it just, that dislocation creates, which is a challenge, creates the opportunity. That's why we're so attracted to space. But really going back to, the original part of your question, the reality is we should have probably rebranded. We should have just changed the name Peachtree Group back in 2010. Us being entrepreneurial and just moving, we're the type of group that moves at 120 miles an hour. When we see opportunity set, we saw this opportunity during the great financial crisis back in 2009, 10, and 11. Started doing the non-hotel deals, and we actually launched a couple of platforms that were part of the Peachtree. Back then, it was Peachtree Hotel Group. Back in 2018, like our C-Pace lending business, commercial property assessed clean energy lending business, started back in 18. That business was dominantly non-hotel. That's where we were lending to all commercial real estate. Our business, and that was a separate business that was part of Peachtree, and then we had our residential business that was out there buying larger tracts of land that we entitled in the subdivisions that I believe I talked about a little bit earlier, where we were selling the lots off the major public home builders. That business was launched, pre-pandemic as well, back in 2018. And the reason I mentioned those two businesses because we did the name change back in like 2021, and that like people were like, well, like now you're doing non-hotel. It just took that education process. Well, no, we've been doing this at more of a scale going back to 2018, but we were really doing it going back to 2010, like, where we bought dozens of non-hotel loans. And we made a bunch of investments, even after that were in non-hotel assets. It's just in a lot of cases to the street, we never really marketed that component. And that was it was a challenge as we try to, from a marketing and branding perspective. But, in hindsight, I think it's worked out, very well, but it was very challenging, back when we initially dropped the hotel and trying to explain that story.
Yeah, yeah. You talk about the mispriced risk, the dislocated markets quite a bit. Can you define what that means? What does mispriced risk look like as far as what the Peachtree looks at it, and where do you see it first?
Sure. So, I mean, mispriced risk is, from our perspective, mispriced risk to the benefit of an investor is, say, let's just say you're all of a sudden able to get a return, like use the 10-year treasury, for instance, at, roughly 4.1% today. Let's say you could invest in something because the 10 years is viewed as risk free. So if you're able to invest in something that's low risk, okay, or the risk level that you quantify be very similar to investing in a 10-year treasury, and all of a sudden you're getting a 20% yield and you have no leverage underneath that structure, similar to like a 10-year treasury, then you're like, whoa, I'm getting 16 points, okay? So I'm getting 100, 1600 basis points of additional return, and my risk profile is, maybe slightly greater than the 10-year T, or maybe it's the same. That's mispriced risk. And so, I mean, the way we sort of, search for it is we're always looking at investment opportunities, and we're looking for things where effectively, like using that example, you're looking at things where you can buy something at a huge discount to the underlying, you know, long-term intrinsic value of that asset. So when you're buying something at a discount to the actual intrinsic value, um, that's a great deal. Like, so if you're buying, a hotel asset, for instance, let's just say you had the ability to buy $100 million hotel asset that had 12 million of NOI today. Okay, so you're buying this, theoretical hotel with 12 million of NOI, and it was located in a location where it was very challenging, if not impossible, to develop new hotels, and you're buying, again, paying 100 million for it, has no PIP needs, whatever the case is. This is an asset that probably should be trading at like a 7, maybe a 7 or 8 cap, like probably, probably sub 7 if there's no ability to develop new. But that would be huge mispriced risk in that example, because effectively, you're paying like a 12 cap asset, right, to buy that $100 million asset, because you got 12 million NOI, and theoretically that asset is probably worth, is probably worth, well over the $100 million valuation. So it's probably worth more like 150 million, right? So you're buying at you're buying at, call it 65, 70% of the true intrinsic value. That is it's a great purchase, and you're going to get returns that are going to be outsized because you're probably going to leverage the deal like you normally would and so forth. And you're going to be generating well north of 20% returns for an asset that should be probably generating returns, that are in the teens, upper teens or whatever the case is. So that's mispriced risk.
Yeah, absolutely. And how do you balance? Are you heavier on one side or the other as far as you're talking about that example, that $100 million deal with it's a 12 cap. Obviously, it's providing good cash flow, good operations, but it also has the potential on the opposite side. If you're going to dispose of it down the road or just re-leverage it, do you weigh one heavier than the other?
Yeah, like the downside risk of it. So
Yeah,
it comes back to the underwriting of it because let's face reality: if you're buying it at a 12 cap, there's got to be something wrong. There's got to be a huge capex need at the asset, right? Because the market's
yes,
way too efficient traditionally. Now that's why sometimes you can find these opportunities. It's very hard to, but it's probably got a huge capex need that you've got to box in that risk associated with the capex piece and understand it. You probably have risk. Maybe the brand's about to leave you, because the brand term is coming to an end. So you may have, you have to go rebrand it. You got risk there. It could be that the operator is just running it way too efficiency. So you got to underwrite is what's happening on the operational side. Is that a one-time event that's occurring there, or is that something that is sustainable? How they're running expenses and so forth. It could very well be just the demand drivers. Is it inflated demand that's not sustainable long term? We've seen many times where an asset just has a huge run up of cash flows. We saw it during COVID because of the leisure, just demand had shot up, where a lot of markets way overshot its long term ability to continue to drive demand. And now we've seen a lot of those markets pull back. So is this artificial demand or is this long term sustainable demand? So you got to really underwrite what's happening from a demand perspective. So it does come back in order to protect your downside for I think at least hopefully I'm answering your question. You got to go back to the fundamentals. You got to underwrite what's driving demand, sustainability of those demand drivers. You got to really spend time with physical plant and see that you have a sustainable building, but understand the capex needs and make sure there's nothing major or unforeseen that's about to come up that's going to impact you. You got to really underwrite the brand and the term left on the agreement and so forth because the brands today are a big driver of demand into these assets. You got to underwrite the location. Like, is there something shifting in the location that's going to cause this asset to have trouble down the road? And so you're looking at those kind of factors when making the decision. And so if you do the correct underwriting on those types of factors and several others, then you should be well protected on the downside, if assuming all that checks out to your benefit. And then you then you have conviction. You got to make the investment.
yeah. And I've heard that you guys and within your team analyze and look at a lot more opportunities than what you're actually performing on, right?
Yeah, we look at thousands and thousands of opportunities on the credit side and the equity side, and we end up if you look at the funnel that we have, like on the credit side, we pretty much see everything that's coming to market on the debt side because brokers send us packages. We have a lot of direct relationships with borrowers. The same goes on we have a capital markets team that's covering like the regional banks, community banks. We see all the notes for sale typically. We have a lot of direct relationships. We work with a lot of the third party brokers that specialize within note sales and things like that. So we tend to see the whole market. And so we end up looking at thousands and thousands of, like, using credit as an example. We'll probably see 5 to 10,000 opportunities in a given year, and we'll make 50 to 100 loans in a given year, against different assets. So it definitely gets compressed down very quickly just due to underwriting, our discipline, just the underwriting side.
Yeah. And as far as the risk goes, what are you seeing as far as the sophisticated investors that are consistently overestimating or even underestimating the hotel cycle right now?
Yeah, I would say, probably one trend I've seen that gives me pause because I think most people tend to have their playbook and everyone sort of varies. And within the hotel space, you have a lot of larger entrepreneurs, that almost feel and look very institutional. You know, Behind closed doors, they're probably more entrepreneurial than institutionalized in how they approach the market, which is not a bad thing at all. I think it's a good thing. But But the reason I say all that is I think one thing that's missing, and surprisingly, even some of the larger, probably the largest private equity shops in the world, they're even falling trap that you could argue to a certain degree some of this. I think everyone, and you see this coming out of cycles. We saw this coming out of the GFC to a certain degree, and we're seeing it today, but it's a little bit different. It's reverse. And, one thing you see is people their mindset tends to shift that, hey, the market is going to be like it was last time, right? And I do believe things do repeat, but they don't repeat in the same way. And where I'm going with this is today, the 10-year treasury is north of 4%. I think there's a lot of people that maybe they don't realize what they're doing, or maybe they do realize what they're doing, but they're making investments with the idea that 10-year is going to revert back to where we were between 2010 and 2022. So they make investments with that mindset and how they value these assets. So a world where the 10-year was on average 2.2% between 2010 and 2022 has a meaningfully different view of asset value than a world where the 10-year over the next 5 years will average north of 4%. And if it averages north of, for some reason it jumps to 5%, that's a totally different scenario too. And so that has a huge ripple effect when you're making investments and your ability to drive returns. And going back to the intrinsic value discussion, that does have a very large impact, because I think it gets lost sometimes. We tend to, sort of quote macro numbers, but like commercial real estate values are down by 20% from first quarter 2022 till now. But I would argue that the true intrinsic values of these assets are down a lot more than 20% on average because of this rate impact. It's just, unfortunately, people see, they're not fully convicted that we're going to stay with a 10-year above 4%. Now, if they're right and the 10-year drops to 3%, again, that's still almost 50% higher than where it averaged between 2010 and 2022. Values are still impacted, but a lot of people are making decisions as if the 10-year is going to go to 3% or less, and I don't think they realize that when they're making their investment decisions on the equity side. But in a world where it stays, the long term stays higher for longer, a lot of investments on the equity side are very challenging to make right now. And that's why it's hard for us to buy assets. It's hard for us to even develop assets because we're using cap rates that are substantially higher than where we were, pre 2022.
Yeah. And how do you adjust that? So if you're underwriting deals, you're used to seeing cap rates at a certain level, and now, nothing pencils out. How do you balance the not doing any deals because it just doesn't pencil the way you want versus changing up a strategy, or giving in and doing some deals just to be doing something when you may not be doing the performing how you would like them to?
Yeah. So I'm a big believer. Some of your best deals are the deals you never do.
Yes.
It's to me, it's almost okay not to do anything. That's one component. I think the other component to it is, again, our original discussion about our ability to pivot, the up and down the capital stack. And we're able to sort of hold the line and be like, we can't buy these assets at valuations that make sense for us. We're happy to go lend, at 60 to 75% of the purchase price on a lot of these assets because it looks meaningfully different. Us being just a lender, yeah, our returns are much less, but I'd rather just be a lender than take on the risk of equity, because that is a huge challenge if rates stay higher. I think a lot of the trades that you saw occur back in 2022, 2023, and it's not just hotels. I mean, I think multifamilies even got more. And I know this isn't necessarily multifamily centric, but multifamily got more impacted than anything, where there was a lot of trades that occur, where, there's one large group that said, it's all clear, it's time to go all in. Let's, like, again, a very well respected group said this back in like 2023, I believe, or towards the end of 2022. And I mean, they called it totally wrong. Like they thought, the 10-year was coming down, because you look at where the 10 years today and where a lot of the multifamily assets are trading on a cap rate basis, you almost scratch your head that there's still a lot of risk in this market. So I just see investors in general underappreciating the risk of investing capital today more than ever. And I think it is I think it's a byproduct of what happened coming out of the great financial. Like today, think about it, during the GFC, we went from an interest rate environment like we are in right now. We had the 10-year was north of 4% right before, pre-GFC. No one saw rates dropping to zero from 2010 to 2022. No one saw that factor play out where the 10-year was cut in half, and it didn't cut in half for a couple of years. That's normally what happens. It stayed that way for like a 12-year run, and so that inflated values up. And so I think people believe that let's dust off the old playbook from the GFC, but that's not what's playing out right now. You're seeing the Fed reduce rates. You're seeing long-term rates actually go up. The 10-year was actually, right before the Fed lowered rates, the 10-year fell below 4%. As soon as they lowered it, it popped back to, four, I think it's at 4.14 right now. And I think the 10-year is probably going to go closer to 4.5. So it's just, this is a very tough environment to navigate. And it's an environment where there's a lot of risk that we're going to end up being a reverse cycle that we saw coming out of the pandemic, out of the great financial crisis, where real estate, commercial real estate in general, when you look at hotels, multifamily, we went through a 12-year run. So I call it decade of overperformance, where it was easy to get 20% returns because of 0% interest rates, to where now we're in the reverse cycle where it's going to be all about, because you're buying assets. In a lot of cases, you're buying assets at a premium to the actual intrinsic value. So it's all about being able to drive rent growth, drive, NOIs. And I think everyone in the hotel business knows this has been a very challenging year in 2025 because you've had, revenues have flat, either grown a couple of points or flat line. In some cases, they're coming down. And you've got your expenses are actually increasing in the lodging space. So it's a very challenging industry as we speak right now, outside of the luxury space that continues to do well. But I think that I would not, as much as I love staying at luxury hotels, we all know if we end up in an economic recession, that's usually the first that falls. So it's, and so that's a whole nother risk in itself.
Yeah. And you spoke about that multifamily group that is a little bit out in front of their skis. I think there's a lot of risk for investors that they want the market to go this direction, or they want their investments to look like this. And that's the way that they know it, the way that they used to have it, and sort of get too far into their own story and selling something that just isn't realistic today. Obviously, we're all salesmen in some level, right? But they sell themselves too hard in one direction that's just not viable.
Yeah. Yeah, I think you're right. And I think I think it's right now, like you have a lot of people too that they need, they need to transact, right? Like they need to transact because, they sold an asset, they have a 1031, they need to transact because they have a platform, they have expenses. I hear this from people all the time that are reaching out to me, and they're trying to find ways to put out capital. And that's a very, I mean, I get it because you're running a business too, and you want to find a way to survive. But sometimes the best way to survive is to do nothing, and let the market clear out. But it's a tough market because there's no, to a lot of people, there's no visibility to when the market's going to shift. And so that's why people start to bet where the market's headed. We're just not in the betting business. We're in the investment business, like I tell everyone on our team. And
Yes.
so we've got to make decisions where we can, again, produce those outsized returns relative to the risk that we're taking. Otherwise, we go out of.
Yeah. And you've successfully built your business to where you're not in the rut where you have to transact. And I think a lot of investors, a lot of groups have built themselves into that rut that in order for them to survive, they have to continue to transact something. And that can lead to some bad long term decisions.
That's right. That's right. And it's yeah, and that's why most, when you think about it, most businesses they're not successful, right? Like it's not, I mean, we were standing in front of the great financial crisis in 2008, 2009. Somebody could argue maybe we got lucky, maybe we didn't get lucky. I mean, if we didn't pivot, I'm probably not here talking to you today, Chase. You're right. Like we would probably went on and did something else. We would have sold, although the assets we bought CFC, we ended up not losing any money on any of those assets. We actually sold them all and actually got our money back and made positive returns on everything.
That's incredible.
But the point is I still probably wouldn't have been here if we didn't pivot, because we would have really just stood idle for several years as we try to work through assets. We wouldn't have been able to grow. And then by the time we got, quote unquote, all clear and everything was good, we would be like, okay, well, we can't, maybe we can raise capital from these existing investors or whatever the case is. We would have just struggled to go, we wouldn't have been in the game. We would have struggled to go buy assets, and we would have, we would have had a much smaller organization than we have today. But it was our ability to pivot and being decisive at the right times. And that is the one thing, is that you've got to, I'm a big believer, you got to look at the macro data. You got to have conviction and be decisive. So when you truly have conviction and you're able to be decisive, that's when, you tend to find your best investments. But also, you got to have that ability to really understand what's happening, to have that conviction to move it forward, because it can get scary for certain people, especially the amount of dollars you're moving at given times. So
Yeah. Walk me through the toolbox a little bit. You've got the bridge, construction, mezz, equity, CPACE, permanent. What is being the most requested right now versus what you are most eager to place?
yeah, so we're doing, surprisingly, we're doing a lot of CPACE loans. A lot of people are using CPACE loans almost like rescue capital. So we're seeing more and more of that, and even banks are coming to us now wanting us to come in and help pay down their loan through a retroactive CPACE loan. So that's becoming more active. I would say our bridge loan by far is the most active product that we do have on the credit side, where we're doing these first mortgage, shorter term bridge loans. These tend to be 3 to 5 year in loan terms, where it'll be like a 3 year loan term, a couple of 12-month extension options. And it provides the ability for an owner of, commercial real estate, hotel assets, to buy an asset, stabilize it, and then refinance it with cheaper capital, or it provides them the ability to refinance. We're doing a lot of refinances, surprisingly, or recapitalizations where loans are maturing, because you've got about $1 trillion of commercial real estate loans maturing over the next 12 months, which is an unprecedented amount of loans. But we're seeing real time the opportunity to do a lot of refinances because of this huge wall of debt maturities. And we're providing a lot of construction loans, senior construction loans. So I would say that's, we'll do several billions of dollars this year of just direct lending. And that's, a big part of our, these first mortgage bridge loans are probably the biggest product that we're offering right now on the credit side.
Yeah, that makes a lot of sense. Jumping into specifically on the hotel side, you're managing 100 plus hotels, right?
That's right.
Where does that management insight feed back into your underwriting, your credit decisions, the way that outsiders can't replace?
Yeah, so it's an appreciation for the operational environment across the U.S., because environments are very different. If you're operating assets in California versus Georgia versus Texas or the Northeast, they're different environments. So we have a very good understanding what it takes to operate assets, in different markets across the U.S. We understand the expenses. We understand what's happening from a demand perspective, in different markets. We understand what different brands are requiring. We understand the challenges of operating these different brands. And if it's because a lot of times people have conversion stories where they're going to convert from one brand to another. We understand like what's the ability really to be successful and drive those additional revenues per available room, which sometimes people tend to be very optimistic. So I think it's our understanding of what's really happening, what's going to be the true CapEx needs at assets, because we own so many assets. We know what it takes to stay in good standing with the brands and the different brands. It's having that ownership knowledge and being able to be a lender with, because we're not lending with the idea of owning these assets. We never want to own any asset we make a loan to, but it's understanding what it means to be the owner. It gives us an appreciation when we're making a loan. We can actually tailor the product to the challenges that owner's going to be dealing with during our loan term, so we can make sure that they can actually appropriately get access to like the PIP dollars, or get, we're not going to inadvertently, throw them into a technical default of some sort. That's one component. Or if a default does occur, we usually have a very good understanding if this is something caused by the borrower, or was this the pandemic. And when it was like the pandemic, we knew, like, it didn't take us educating us what was happening. I mean, surprisingly, we had lenders we had to educate during the pandemic to get deferment of payments and things. But on the equity book side, and we got some help there from time to time. But when we were the lender, we worked with our borrowers and we understood what was happening. We understood the challenges, and we were able to structure things that made sense for both sides.
I would imagine that helps with that conversation quite a bit, that the debt side inside and out, the equity side, the operations and the management side. It's not that you can the wool pulled over your eyes, or everybody knows who you are and what you're doing, and they know that your team has the expertise to understand what's going on in the market.
That's totally right. And I think that's why, honestly, we have a lot of repeat borrowers that come to us because we're more expensive than a bank. But they utilize us because I think they realize and appreciate, they know that we're going to be able to work with them when there are challenges, and it's going to be a lot easier from an asset management perspective than dealing with a bank that's just going to be like, or just a CMBS lender, a bank, an insurance company is going to be like, hey, just pay me. Whereas we're going to be like, okay, we understand what's happening. Let us try to work through this. Let's work through loan extensions. If it's a loan maturity, we understand all the stuff that could be happening, and it's our job. We obviously want to get paid, but we also understand if there's been disruption to cash flows that are outside of your control. We're gonna try to work with you to make something work for all sides.
As an investor, as a borrower, you also want to know that the lender knows what they're doing, and they have the ability to underwrite it properly, because it is a partnership. And as an investor, I've been on this multiple times where you get into something, you get excited, you want it to happen, and you just want to make it happen, and you don't really want to see the downside, you don't want to see the risk, not paying attention to it. But if you have somebody on the lender side who they're doing their strict underwriting as well, that analysis is worth a lot to the investor.
I totally, completely agree with you there.
Awesome. Well, Greg, I could talk to you for hours here. I want to respect your time. I know you've got a lot going on. Thank you so much for jumping on. I'd love to continue the conversation down the road.
Yeah, Chase, appreciate the time as well. And if I can ever be of help, let me know. And really appreciate you taking time to talk to me today.
Sounds good. You have a good one. I'll talk
All
to
right.
you soon.
All right. Sounds great. Thank you. I'll see you.